We're looking at a live shot right now from Ottawa as we await comments from Canadian Prime Minister Justin Trudeau after Canada just announced 25% tariffs on more than $20 billion worth of U.S. goods. Now, that announcement was in retaliation to the new tariffs that went into effect shortly after midnight from the Trump administration. Nearly $130 billion in U.S. goods will be impacted by China and Canada's retaliatory measures. Joining us now to discuss what's at stake in the escalation in the global trade war here, what this ultimately means for the U.S. consumer. We want to bring in Justin Wolfers. He's a University of Michigan professor of economics and public policy. Justin, it's great to have you here on Yahoo Finance. Just talk to me just about the implications of this escalating trade war, what it ultimately means here for U.S. economic growth.
Right. So there's two sets of issues here. There's the tariffs that the U.S. has put on the rest of the world. Those tariffs, to be clear, are actually not tariffs on the rest of the world. They're tariffs on Americans. When you go to buy a washing machine from Home Depot has imported that washing machine from abroad. In order to clear customs, Home Depot now has to pay tariffs on that washing machine. Home Depot, simple law of economics, when costs go up, you jack up your prices. Home Depot is going to jack up your prices. So you and I and all your viewers are going to see higher prices for the goods that you buy from Mexico, Canada and China. That's 2/5 of our imports. That includes a lot of the fruit and vegetables that certainly my family eats every week. Then there's the tariffs that are in retaliation. Each of these countries has already announced retaliatory tariffs. That says that the global marketplace that has historically been open to American businesses, where we can produce the best stuff in the world and sell it all around the world, is starting to become closed. Look, we've seen this movie before. This was the first Trump tariffs under the first Trump administration. China put retaliatory tariffs on American farmers, and it didn't take long before they went to the White House asking for payouts in order to help them struggle through what have become very difficult business conditions. So we're going to pay more at home. They're going to struggle to do business, and in a couple of months, you'll be looking to see American taxpayers bailing out American companies that have been hurt by these White House actions.
So, Justin, who do you think is going to blink first, the Fed or Trump, when it comes to especially the market reaction to some of this tariff news and the potential that the market is going to erase all of the post-election gains that we've seen?
So, to be clear, the U.S. stock market today, measured by the S&P 500, is at a lower level than it was the day before the election. That's the U.S. stock market judging that the current administration is less good for the future profitability of American businesses than they thought the day before Election Day. And this is despite the very large tax cuts promised by the administration. So it's a very sharp vote of no confidence. I don't think that this is a question of who's going to blink. It's not a strategic interaction. Canada's not trying to get us. They're not trying to knock us out of any particular market. They're just there doing exactly what we all thought we'd agreed to do with NAFTA, which is coming together to see if we could produce more together than we could apart.
Right.
They went through the circus
Justin,
renegotiating it.
Just to be clear, sorry, I mean, is the Federal Reserve going to potentially react more quickly to any market negativity that we're seeing than the Trump administration?
I don't think so. The Federal Reserve partly wants to stay apart from politics. Also, at the moment, we haven't yet seen any impact on growth. It'll cause growth to slow. That would normally cause the Fed to cut interest rates, but it's going to cause inflation to rise. That would normally cause the Fed to raise interest rates. So it's a very difficult balancing act. But I don't think of the Fed as being a particularly major player here. We do know that the president historically listened very closely to what financial markets were saying. Financial markets are saying they hate his latest actions.
You know, Justin, I'm curious just in terms of some of the recent data and some of the trends that we are seeing. And Sam Rowe of the Ticker, in his post this morning, reflected on a chart that Morgan Stanley recently published, if we could pull that up. And they talked about on earnings calls. They did an analysis right now of earnings call transcripts. And they were talking about the pull forward mentions that we're starting to hear and that we have heard from a number of companies here over the last several weeks. And we have seen that number tick higher here in the most recent quarter. I guess my question to you is, ultimately, what impact does this have on the economy? To what degree is this really moving the needle, if at all?
Right. So there's a very weird short-run thing that's going to happen, which is we all knew tariffs were coming. And so some of the more sophisticated players realized, let's get in there and buy. I had neighbors who bought their family car in January rather than waiting till March. But more than that, we've seen businesses that need raw materials really pull forward a lot of their spending from what would have been March and April into January and February. In some sense, by the way, this means that the Trump economy began before he actually came to power because people understood what he was going to do. So that has led to a very sharp surge in imports in January. We've got the early data on that. In February, we're going to see an even sharper surge. The US trade balance blows out. And that's going to have all sorts of weird effects through the rest of our economic measures. So my advice to your viewers is be very careful about interpreting economic data over the next few months, because you'll see a huge surge in imports followed by a huge decline in imports, both of which are basically due to trying to front-run the imports. And that's going to have effects all through our economic data. And it's actually going to be several months until we see what the underlying shape of the economy really is.
So how does that viewpoint impact your thesis about where we're at in this economy, Justin? And how should our viewers be thinking about how much weakness there is in this economy? Is there significant, substantial weakness? Are we in the middle of a slowdown? How would you characterize it?
So I think I'm an optimist. The president inherited actually a remarkably strong economy. We have unemployment very low. We have inflation around about 3% and heading back down to 2%. We have the Fed on a path back to normalization. We have reasonable rates of economic growth. So before January 20, I was thinking to myself, wow, this all looks pretty good. And that's basically the answer I want to give you. The problem is a lot has happened since January 20. There's two shocks in particular I want you to keep your eye on. The first is if you look at measures of economic uncertainty. They're at almost record highs now. The pandemic actually caused higher levels of economic uncertainty. But beyond that, we've never seen uncertainty like this before. And if you were the CEO of a major business thinking about breaking ground on a new factory or purchasing new robots or overhauling your software, you might think to yourself right now, amidst all this uncertainty, you know what, I'm going to wait 3 months to see how all this pans out before I start spending money. Now, if enough factories do that or if enough families do that, that creates its own economic problems. And then the second thing we're already seeing is consumer and business sentiment have really cratered over the last couple of weeks. What the president has been doing has been immensely unpopular. The American people don't believe that this will be in their best interests. And the real question for the economy is people say they don't like it. Are they going to act that way? If so, they're going to pull back on their spending, and if that's the case, that could be the first shot fired in something of a downward spiral, and I'm very worried about that.
And on the topic of consumer spending, we're just pulling up a chart of that Moody's study that I know you've heard about from this week. The top 10% of earners are making up half of consumer spending. What impact does that dynamic and that wealth gap and spending gap have on the economy if it continues?
Look, the economy's not some weird third thing that's out there. It's you and me and our lives. And if a small number of people get to do half the spending, that means a smaller number of people get half the stuff. And that means there's less stuff for the rest of us. It's as simple as when we have enormous inequality like this, that suggests there are many families that are doing without. And the only ways to help those families are to grow the pie and to grow the size of the slice going to those folks. And they're the two ways forward, and I'm not sure which of those is the Trump administration's current goal, because it appears to be serving neither goal well.
All right, Justin, thank you for breaking it down for us and joining us. We really appreciate your insights. Thank you.
A pleasure.